FM crash September 2024. Okay. The student, obviously, very quickly, let's just start the first topic, a little bit different. Start from cost of capital. After cost of capital, we'll go down to investment appraisal, inshallah. Let's just start with cost of capital. Number one, what is the objective of cost of capital? Quickly, any answer? Objective of cost of capital. Any answer, students? What is the objective of cost of capital? If someone asks you a question, what is the objective of cost of capital? The answer is investment appraisal. Objective is investment appraisal. Actually, we calculate cost of capital. We need cost of capital for investment appraisal. Second, cost of capital actually represents cost of financing. Repeat. Another question is, if someone asks you a question, what do you mean by cost of capital? Actually, cost of capital represents cost of financing. Cost of capital represents actually cost of financing. Now, when we say cost of capital, another name is weighted average cost of capital. So first of all, we need to learn how to calculate the cost of individual source of finance. And then obviously we'll calculate weighted average cost of capital. If an entity raises the finance in the form of equity, if an organization raises the finance in the form of equity, then the cost is cost of equity KE. How do we calculate KE? By using CAPM, capital asset pricing model, and dividend valuation model. Another name is DGM, dividend growth model. We can calculate KE, cost of equity. There's third model as well, which is MM plus tax equation, but that is not in FM. You will study in AFM, inshallah. So if an entity raises the finance in the form of equity, then it is calculated by using CAPM. Another way is DVM. Second, if an organization raises the finance in the form of debt, then the cost is KD1 minus T. Why KD1 minus T? Basically, when an entity raises finance in the form of debt, then obviously on interest payment, company is going to save the tax. Interest payment, company saves tax. That is why when we say raising the finance in the form of debt, then your cost is cost of debt after tax, because interest payment results in tax saving. Third possibility, that is preference shares. If an entity raises the finance in the form of preference shares, then the cost is KP. That is cost of preference shares. And we will discuss also, if there are redeemable preference shares, then how do we calculate KP? If there are irredeemable preference shares, then how do we calculate KP? Okay, now. Okay. If an entity raises the finance in the form of equity, then cost of equity can be calculated by using CAPM. The formula of the CAPM is capital asset pricing model. The formula is K is equal to RF plus RM minus RF and then equity beta. K is actually cost of equity. Cost of equity. Another name is minimum return required by the shareholders. minimum return required by the equity holder, required by the shareholders. RM, average return on stock exchange. Average return on stock exchange. RF is risk-free rate of return. RF is risk-free rate of return. RM minus RF is equity risk premium. Equity risk premium. Another name is market risk premium. Market risk premium. Okay. This is equity beta. Before developing the understanding of equity beta, you need to know only beta. Actually, when we say beta is a measure of risk. Beta is a measure of risk. Beta is a measure of risk. What beta does, beta measures risk. Okay. When we say risk, logically, there are two types of risk. We have systematic risk and unsystematic risk. Unsystematic risk is a diversifiable risk. Unsystematic risk is a diversifiable risk. This risk, yes, these lectures will be uploaded on the YouTube after the class, obviously. Before the class, we cannot do that. Unsystematic risk is a diversifiable risk. Diversifiable risk means which can be spread, which can be reduced, even which can be eliminated. Okay. Now, listen carefully. According to the CAPM, capital asset pricing model is having number of assumptions, but out of those number of assumptions, one of them is investor is having a well-diversified portfolio of investment. That is why we always assume unsystematic risk. In CAPM, it is 0. And always remember one point, we assume investor is having a well-diversified portfolio of investment, not the investee, investor. Okay. Now, let's talk about systematic. Okay, unsystematic risk. How can you diversify this unsystematic risk? For example, if you go to the stock exchange, instead of making all the investment in one company's shares, if you spread your investment and you invest in, let's say, different companies, so we'll say that you are diversifying your risk. A classic example which I normally provide, if someone is having a $1 million, if that company invests assuming entire 1 million in only in a single organization shares, then what happens? If that organization's share price will increase, your 100% investment will increase. If the share price of that company reduces, then 100% investment will reduce. Now, another way of investing at a stock exchange is 1 million divided by 20, I'll get 50,000. $50,000, which is the 5% of 1 million. It means if someone makes investment in different 20 organizations, and each company, if you invest $50,000, investing in a different 20 companies, and in each company you are investing $50,000, which is 5% of your total investment. It means we can say that you are having a well-diversified portfolio of investment, because by doing this, if a single company share price reduces, so you will be having a loss in 5% of your investment. Still, there are 95% chances you will get the benefit. Even the share price of two companies, it reduces. Still, there will be 90% chances you will have the benefit. This is how you diversify your investment, how you diversify your risk. And this is if you have a well diversified portfolio of investment, which we assume, that is why we say you do not have any unsystematic risk. Now we are left with systematic risk. This is not a diversifiable risk. Not a diversifiable risk. We cannot diversify this risk. Actually, you have to face this risk. For example, if your government increases the tax rate, you cannot do anything. You have to bear. Increase in the inflation rate, increase in fact, interest rate. So we can, actually, my company cannot reduce the interest rate. So these are the just few examples of systematic risk. Or systematic risk is not a diversifiable risk. In fact, political unrest is also one of the examples of a systematic risk. Okay, now in capital asset pricing model, we have the assumption that investor is having a well diversified portfolio of investment. That is why unsystematic risk is zero. So we are left with only systematic risk. Now, when it comes to equity beta, actually we say equity beta is a measure of systematic risk. Which indicates that how your investment will respond to the changes in a stock index. For example, if the index increases by 2% and your investment increases by 4%, it means you are earning more than the market. If you are earning more than the market, your investment is riskier than the market, because if the market reduces, then your investment will reduce more than the market. So simply equity beta, another definition of the equity beta is a residual beta, residual risk, because the total risk is systematic plus unsystematic. And in CAPM, we assume that investor is having a well diversified portfolio of investment. That is why unsystematic risk is zero. So we are left with the residual risk. The remaining risk is systematic risk. Equity beta is a measure of remaining risk, residual risk, systematic risk. Now, let us quickly work on few findings, and I want everyone to use the calculator. Let's say RF we have 7%, RM we have 15%. Equity beta is 0. Equity beta is 0.8. Equity beta is 1. Equity beta is 1.75. I need KE in every case. Obviously, there will be 4 KEs. Quickly answer, please. Number 1. Can I say K is equal to RF plus RM minus RF into 0? We'll get K is equal to 7%. So please look at this finding number 1. When equity beta is 0, it means that your investment is not facing any risk. And there's only one investment which does not face any risk. That is government bond. When you are making investment in government bond. So if my investment is not facing any risk, I'm not facing any risk, then I'll ask the return, I'll demand the return which is equal to RF. So whenever equity beta is equal to 0, your KE will be equal to RF. And always remember one point, that in financial management, benchmark of risk-free investment is, the benchmark of risk-free investment is investment in government bonds. Why they have made benchmark of risk-free investment the government bonds? Because normally, please concentrate on my wordings. I'm saying normally governments, they do not collapse. I'm not saying they will never collapse. I'm saying normally they do not collapse. We have seen in the past, there are a number of governments, they collapse, but normally we say governments, they don't collapse. That is why in financial management, the benchmark of risk-free investment is government bond. That is number one finding. If beta equity is equal to 0, K will be equal to RF. Second, K is equal to 7%. RM is 15 minus 7 and equity beta is 0.8. Let's see what are we getting. Students, I'm getting 13.4%. Okay, now listen. Second finding, whenever equity beta is less than 1, your K will be less than RM. Actually, equity beta less than 1 means your investment is less riskier than the market. When my investment is less riskier than the market, then I will demand the return which is lower than the market. Third, K is equal to RF plus RM minus RF, and I think equity beta is 1. Let's see.
Sorry, sir, just repeat what you said just
Equity
now.
beta is 1, your K will be equal to 15%. Now listen, equity beta 1 is a benchmark beta. Equity
when
beta
you
is equal to
started
1 is a benchmark beta, and this beta means systematic risk of your investment is equal to the systematic risk of stock index. It means systematic risk of your investment and systematic risk of the market both are equal. Can I say when my investment is facing the same risk which market is facing, then I'm going to demand the same return which is on average exist in the market. So KE will be equal to RM. Fourth and last, K is equal to 7, 15, this, and let's see. Equity beta is 1.75. I'm getting 21, something different. Okay. Let's see, 15 minus 7 to 1.75 plus 7. Students, I'm getting 21. Yes or no, please reply. 21. Now listen and listen carefully. Equity beta, whenever equity beta is more than 1. Equity beta more than 1 means equity beta more than 1 means your investment is more riskier than the market. When your investment is more riskier than the market, it means I'm going to demand the return which is more than the market. So whenever equity beta is going to be more than 1, your KE will be more than RM. Systematic risk, I said systematic risk is not a diversifiable risk. Examples are increase in interest rate. Obviously, you have to face it. You do not have any other choice. I have given another example, increase in inflation rate, increase in tax rate. Even I said political unrest is one of the examples of systematic risk. So systematic risk is not a diversifiable risk. Now, another way of calculating KE is dividend valuation model, DVM, dividend valuation model, dividend growth model. By using DVM, we can calculate KE. So KE is equal to D naught 1 plus G upon P naught plus G. KE, we know that cost of equity. Another name is minimum return required by the shareholders. D naught, current dividend per share. Current dividend per share. G is the annual dividend growth rate. Annual dividend growth rate. Now, please listen carefully. In dividend valuation model, we assume that annual dividend growth rate is constant. P naught. Current share price ex div excluding dividend. Nothing is mentioned. We always assume given share price is ex div. For cum div, examiner is going to mention cum div price. Okay, now D naught 1 plus G is actually equal to D1. Next year expected dividend. It means D24 1 plus G will give you D25. Let's say dividend per share is $0.30 in 2020. Dividend per share $0.34, 21, 22, 23, 24. Current share price is 20.4. Cum div. Required is K. Students, quickly answer. Whatever you think is the correct answer. Dividend per share, they have given us 0.30, 0.34, 35, 38, and 40. Current share price always represent the last year. Obviously, first we have to calculate the annual dividend growth rate. Annual dividend growth rate is equal to last dividend per share divided by first dividend per share. Now let us first count the number of years. 1, 2, 3, 4, 5. I have 5 years, so power is going to be 1 upon 4. If there are 10 years, so power is going to be 1 upon 9. Because if there are 10 years, so growth will come 9 times. If there are 5 years, then growth will come 4 times, minus 1. Now listen carefully. Obviously, you have to solve this on Excel. So logically, 1 upon 4 is 0.25. So it means so let's use the calculator. What are we getting? Whatever answer comes, multiply by 100. I'm getting 7.45%. Students check yes or no. Okay, now K is equal to D naught into 1.0745. See, it is 20.4 current share price, but it says come div. So I have to deduct the dividend. So X div is 20 plus the growth rate. Okay, let's see. K students, they are replying this. Nice. It is 9.6. Perfect. Yeah, 9.599 or 9.6. Great. There's another formula of calculating growth rate. Obviously, it depends on the data, what sort of data examiner has given you. Like another formula relating to the G is Gordon growth model. Gordon growth model. By using Gordon growth model, we can calculate annual dividend growth rate. G is equal to B RE. G, we know that this is annual dividend growth rate. Annual dividend growth rate. B is the retention ratio. B is retention ratio. Now, what do you mean by retention ratio? Basically, if company is paying 40% dividend, it means they are retaining 60%. If company pays 30% dividend, it means they retain 70%. And always remember one point. Always remember one point. That is, entities they retain to reinvest. Entities they retain to reinvest. So logically, B is equal to 1 minus payout ratio. Because if we deduct payout ratio, so from 1, we'll get retention ratio. How do we calculate payout ratio? D not upon EPS. Obviously, entities they pay in the form of dividend out of their earnings. So dividend per share divided by earning per share. Calculating EPS in financial management is very easy as compared to FR. In FR, actually, we follow proper IAS 33. But when it comes to FM, even AFM, earning per share is very straightforward. Simply profit after tax divided by total shares. This is how we calculate earning per share, PAT, divided by total ordinary shares. RE is return on equity. Simply profit after tax divided by total equity. And there's a possibility that instead of RE, examiner can use the word return on investment. There's a possibility. There's a possibility that examiner instead of RE uses the word return on investment. Okay. How do we calculate earning per share? Profit after tax divided by total shares. Profit after tax divided by total shares. Shareholders' return is different than return on equity. In shareholders' return, you will have dividend as well as capital gain. That is shareholders' total return. So total return of shareholders will have two things. One is dividend and another is capital gain also. Return on equity is different. Okay. Let's say D naught is $2. EPS is $8. Current share price is $40. Required. Student, quickly calculate K, please. What is K? D naught is $2. Earning per share is $8. Current share price is 40. Return on investment is 20%. I need K. Please answer. What is the answer? Okay, one student has given the answer 10.25. What about others? B is equal to 1 minus payout ratio. Can I say retention ratio is 0.75? So B is equal to 1 minus payout ratio. I'm getting retention 0.75. So G is equal to BRE 15%. D naught, there's 40. Okay. And 20.75. Now majority is having 20.75. So 20.75 is the correct answer. 20.75 is the correct answer. Okay. $20.75. Return on investment. I think I mentioned something here. RE's return on equity, there's a possibility examiner can use the another term for return on equity, that is return on investment. Okay. Let's say we have RF 7%. RM we have 15%. Equity beta 1.75. Dividend is $40 per share in 2023. Dividend 0.46 in 2024. Required. P naught. Students, please quickly calculate P naught. I need P naught. Please, every one of you, attempt this. Okay, one answer is 15. What about others? Please, only one answer so far. What about others? Quickly, please. Let's see who is going to get the correct answer. I want everyone to attempt this question. So far, 3 students have given the answer, and surprisingly, each one is having a different answer. Let's wait for 2 more students, and the 4th and 5th one has they have also given the different answers. Let's solve together now. Okay, everyone is giving different answers. That's very nice. Oh, another question is wow. Let us calculate K. 7. 1.75. So 15 minus 7 into 1.75 plus 7. So K is 21. Okay. So we have given the information of dividend. So latest dividend divided by the first dividend minus 1. So let's see what are we getting. Growth rate is 15%. Growth rate is 15% because we have 2 years. So power is going to be just 1. So even you put 1, so no issue at all. If you have been given 10 years, the power is going to be 1 upon 9. Okay, now let's come here. K is equal to D naught 1 plus G upon P naught plus G. It means it can be written like this. We can also write like this. Now the subject is P naught. So the current dividend is 0.46. Growth rate we have calculated 15%. K we have calculated 21. So it means, let's see. 8.81, yes, no? Why 2.54? Please, student, check this. Please look at this formula. If you want, I can do the little bit maths for you. P naught, we are dividing here, so little bit maths. If I bring P naught here, it will multiply like this. When two variables they are multiplying, if I take this K1 minus G to the other side of is equal to it, it will go in the denominator. I think we have already, I've shown you how to calculate. This is how we calculated the growth rate. And this is not the first time we are using this formula. Look at it. Someone is, please don't use this Zoom, something like that. Look at this. The question we have already calculated the growth rate. Look at this. Here, the dividend information examiner has given us 5-year data. So how we have calculated the growth rate? Last dividend divided by first dividend, the power was 1 upon 4. 1 upon 4 means 0.25. So if you have been given 5 years data, the power will be less 1. So 5-year data means the power is going to be 1 upon 4. Here the data is just 2 years. Examiner has given you the information of just dividend of 2 years. So power is going to be 1. So obviously there's no need to write power 1. So last dividend divided by first minus 1, whatever comes into 100, you will get growth rate 15%. Okay, now come here. Please, I need answer of this question. T1, T2, T3, T4 till T infinity. Dividend per share is 0.46, 0.55, 0.56, 0.56 into 1.04% into 1.04. K is 10%. I need P naught. Please, everyone, attempt this. Try to calculate P naught. One student is given the answer 5.824. What about others? Please, others should also try this. Okay, let's see. We have got different answers. Let's see. Now listen. Actually, whenever you have given information like this, so just you need to know one thing: present value of all future dividends till perpetuity will give you P naught. How? Let's see. All you need is just calculate the present values. So 0.909, 0.826, 0.751. Now look at this, please. K minus the growth rate, whatever comes, multiply by the previous year discount factor. If you need, let's say, perpetuity factor from T4 onwards, so you have to multiply this with the previous year discount factor. This is what you just need to know. Now let me use the calculator. Let's see what are we getting. 0.46 into 0.909, 0.418, 0.55 into 0.826, 0.4543, 0.42. Zero 0.56 into 1.04 divided by 0.06 into 0.751. Students, here I am getting 7.2897. Zero 0.418 plus 0.4543 plus 0.42 plus 7.2897. I'm getting the final answer 8.582. Okay, one more question. This is P naught, and I want everyone to solve this, please, now.
Sorry, sir.
T1, T2, T3, T4, T5
Excuse me,
till
sir.
T infinity.
Can you repeat?
Dividend per share. Four zero 424545 into, let's say, 1.05. KE is 10%. Please, now I want you to calculate P naught quickly. P naught, please. Everyone. P naught, please, quickly. Okay, different students are getting different results. Let's see what is the right answer. Let's see. Majority of the students, they are getting the more or less same results. First year 0.909, 0.826, 0.751, 0.683. K minus the growth rate I need the factor from T5 till T infinity. So multiply this with the previous year discount factor. Let's see. 0.4 into 0.826. 0.42 into 0.751. 0.45 into 0.683. 0.45 into 1.05 divided by 0.5, 0.683. 6.45435. Okay. 315. Students, I'm getting 7.4. I think majority was having this also. Please check yes or no. 7.4 is the P naught. This is the growth rate. This is the growth rate. Growth rate. This is the growth rate. P naught is equal to D naught. 1 plus Z upon K minus Z. Whenever you need to use this formula from T1 till T infinity, then you will get the answer directly. Whatever comes, that is your final answer. But if you want to use this formula, for example, from T4 till T infinity, you just need to know one thing. D naught 1 plus G K minus Z. Whatever comes, if you need the present value from T4 till T infinity, then you have to multiply this with a discount factor of previous year. Basic investment appraisal concept. Okay, come here, please. Look at the logic. I need annuity factor from 4 till 10. Cost of capital is 10%. Please answer, everyone. I need annuity factor from 4 till 10 and the cost of capital is 10%. What is the answer? Please, every one of you. I'll give you the logic. Why do we multiply with the previous year discount factor? Okay, one student is given us answer 3.7. What about others? Okay, let's see. How do we calculate? Let me show you. Annuity factor from 1 till 10. 1 minus 1.1 minus 10 divided by 0.1. First, we'll calculate annuity factor for the 10 years. Let's see what is the answer for the annuity factor of 10 years. Students, I'm getting 6.144, make it 5 also. See, it's just a simple annuity factor and 4 to 5 student, everyone has given me the different answer. And exams are so near. So you people can just realize where do actually we make mistakes. Now, actually, I need annuity factor from year 4 till 10. 4, okay? 4. So I will deduct annuity factor for the first 3 years till the previous year. So 1 minus this minus 3. 2.48, okay, 68. 2.4868. Let's see what are we getting. 6.1445 minus 2.4868. 3.6577. Yes or no? Okay, now how we have calculated this? First, we calculated annuity factor for the first 10 years. Now, student, listen carefully. Actually, we want annuity from 4 till 10. 4, okay? Till 10. And we deducted till 1 till 3. Yes or no? At least reply on this. Have you deducted year 4 also, or just till the previous year? Students, have we deducted till 4 or just till the previous year? Good. Now, please keep watching. Now, let us just count. Can I say from 4 till 10? There are total 7 years. Yes or no? Please reply on this. 4 till 10, how many years are there? 7. Okay, keep watching. Just keep watching, please. Let's see the annuity factor for the 7 years. Let's see, what are we getting? Students, I'm getting 4.8684. Yes or no? Please reply. Great. Just great. I need annuity from 4 till 10. Yes or no? What comes before 4? 3 years. Look at this. Discount factor of previous year. Means T3. 0.751. Please use your calculator. What are we getting? Please use your calculator. We getting the same result, yes or no? Is this clear? Why we are multiplying with the previous year discount factor? Just another way of calculating the same thing. So whenever, please, you should know this thing. Whenever you want to use this formula till infinity from, let's say, T5 till T infinity, T5, so you have to use the discount factor of the previous year. Now come here. Okay. If an entity wants to raise the finance in the form of debt, we know that the cost is KD 1 minus T, cost of debt after tax, because fixed payment of interest results in tax saving. Now listen, when it comes to KD 1 minus T, so there are number of debts. Number one, let's say take the bank loan. In case of bank loan, it's very simple to calculate KD 1 minus T. For example, if we have 10% bank loan, and let's say the tax rate is 20%, then simply your KD 1 minus T will be 8%. In case of bank loan, we also assume book value of bank loan is equal to the market value. In case of bank loan, we always assume book value of bank loan is equal to market value. Second, irredeemable bonds. KD1 minus T is equal to I1 minus T upon P naught into 100. P naught is current bond price X interest. Current bond price X interest. I is the cash interest. Cash interest is always paid on par value. If par value is not given, we always assume par value is 100. T is obviously is the tax rate. Question. Let's say we have 10% irredeemable bonds. Par value 100. Market value of bond is 125. Come interest. Tax rate is 20%. KD1 minus T. If tax rate becomes 30%, calculate impact on KD1 minus T. Please, everyone, solve this. Nothing is mentioned. I've already, okay, let me write. Okay, it's written here. Otherwise, nothing is mentioned. We always assume par value is 100. Please, I need the answer of 1 as well as 2. Okay, let's see. Reduce by 1%. Number 1. Interest is 10. Tax rate is 1 minus T. Okay, and it is come interest, so I'll deduct the interest. It becomes X interest 115. Let's see what are we getting. 6.956%. Second, actually, your answer is not KD1 minus T will not be your final answer. They've asked something else. (6.086%) or make it 7. KD1 minus T reduces by 6.956 minus 6.086. 6.956 minus 6.086. 0.87%. Okay. And definitely tax rate increases, KD1 minus T will reduce. Now, there's a possibility of redeemable bonds. Okay, why we did not use 125? What is written, please? Come interest. We use X interest. We use X values because come value does not exist. Come value does not exist every day. On average, every day you will be having X values, not come values. Come means including. We need excluding. Because come values, they exist only for few days. X values, they exist on average more or less every day. And we are going to use this cost of capital in investment appraisal, and investment appraisal is a long-term decision. It's not a short-term decision. Okay, redeemable bonds. In case of redeemable bond, we calculate KD1 minus T by using IRR. And now we know that the shortcut of IRR is available. By using the shortcut of IRR, we can very easily calculate KD1 minus T. You just need to know the inputs. Let's say T0, T1, T2, T3, assuming the maturity period is 4 years. T0, market value of bond. If you want, you can just take interest here, only interest. 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 Here you will have to take interest plus redemption amount. And when it comes to redemption amount, so we always say RTQ. Read the question carefully. Nothing is mentioned, then redemption will be at par value. And we assume 100 if nothing is given. But redemption could be at premium. If it is at premium, then examiner will be, obviously examiner is going to mention that. There's a possibility of conversion value also. But conversion value, please listen carefully. When this conversion value is possible, number one, the given bond must be a convertible bond. In case of convertible bond, basically investors, they have two options. One, at maturity, they can ask for the redemption amount, or if they want, they can convert the convertible bond to into shares. Obviously, whichever is higher, investor will choose that option. If conversion value is higher than the redemption value, then obviously investor, they will go for conversion value. Okay. Let's say you have written all the inputs of IRR. After that, whatever the answer comes by using the shortcut of IRR, that will be actually KD. Because I'm using only interest. If you are using interest 1 minus T, then your answer will be directly KD 1 minus T. Right now, whatever comes, it will be just KD. For example, the KD is 6%. Then you can very easily make it KD 1 minus T. Let me just show this on Excel. Just a minute. Let us go towards Excel, Excel. Mhm. Just let's say 0, 1, 2, 3, and 4. Cash flows, assuming market value is 115. 100 into interest rate is 10%. Option of the drag. In the last year, you have to take the redemption amount. As I mentioned just right now, redemption could be, nothing is mentioned, it will be at par value. In case of premium, it will be mentioned premium. And there's a possibility of conversion value also. Let's assume we are redeeming at par value. Now KD is equal to IRR. Just take all the values. Bracket close. This is KD. We actually need KD 1 minus T. I'm assuming that tax rate is 30%. Just an assumption, okay? If tax rate is 30%, so multiply this with 0.7. We are getting 4.4% or 4 point, let's say, or 4% at 3.99. So first we calculated KD, after that just 1 minus T. So now dealing with the redeemable bond, it has become obviously very easy because of this shortcut which is available. Okay, now let's go back to the OneNote. Okay, just a minute. Okay. If an entity raises the finance in the form of preference shares, KP is equal to D naught upon T naught into 100. KP is the cost of preference shares. D naught, current dividend per share. P naught, current share price. Obviously, current preference share price, so that you should not get confused. Current preference share price. For example, we have 6% preference shares. Nothing is mentioned. We always assume given preference shares are irredeemable preference shares. Logically, this formula is for irredeemable preference shares. Par value is $0.5. Current share price is $0.73 cum diff. Here we are using X diff value. Students, please quickly, I need KP. Please answer. I just need KP. What is KP? Okay, the answer is around 4%. D naught will be par value into 0.06. Zero 0.73 minus 0.03, 0.7. So it is 4.285, or you can say 286. If examiner gives you redeemable preference share, number one, categorically it will be written for the redeemable. In case of redeemable preference shares, KP is calculated by using IRR. In case of redeemable preference shares, KP is calculated by using IRR. Simply time 0, 1, 2, 3 and assuming 4. Here you will take market value of preference shares, market value of preference share. Simply dividend plus the redemption amount. An examiner will give you the redemption amount. After that, KP is equal to, you will be using the shortcut of IRR, it will give you KP. So in case of redeemable preference shares, I've never seen in the past paper, but if it comes, all you need is just use the formula of IRR. Okay, now. In case of diversification, how do we calculate risk adjusted WACC? Diversification means making investment in a non-core activity. Diversification means you are making investment in a different industry. Diversification means you are making investment in a different industry. You are doing something different. So what are the steps of calculating a risk adjusted WACC in case of diversification? Step 1, to find beta asset of new industry. No. In case of, if your examiner says redeemable preference shares, redeemable, and writes redeemable preference shares 5 times, it can never be 1 minus T. 1 minus T is only for the bonds. It is not, 1 minus T will not be for preference shares. Even they are redeemable. Is this clear now? Because taxation authorities, they will not accept your redeemable as a loan. Okay, diversification, risk adjusted WACC. What is the approach of calculating a risk adjusted WACC in case of diversification? Step 1 is to find beta asset of the new industry. How do we calculate beta asset of a new industry? And let's say you have calculated the beta asset of a new industry, then you will gear up with your own gearing to calculate equity beta. So basically, in case of cost of capital, the final topic which I'm going to discuss, that is going to be how to calculate WACC of how to calculate risk adjusted WACC when an entity is diversifying, when an entity is making investment in a new industry, is doing something different. So inshallah, we'll start tomorrow our crash live class 2 from this concept. Timing is going to be same. And after the discussion of how do we calculate WACC or risk adjusted WACC, we'll go towards investment appraisal. So timings will be same. So you should be in the WhatsApp group. So thanks a lot, student. Thank you very much. See you all inshallah tomorrow. Have a nice life. And do remind me that from where I have to start. As far as I remember, we'll start from risk adjusted WACC.